Thanks for the opportunity to moderate the panel with this esteemed group of professionals. As Dan said, I've got probably 30 plus years of some combination of private equity and restructuring experience. And I've been an interim CEO, COO, CFO, CRO, probably all of the alphabet after it, but with companies that have ranged between 25 million and 500 million in revenue with multiple operations. At this point, just a couple of other housekeeping items. One, unfortunately, the webinar is not set up to provide CPE or CLE credits, so we apologize for that. And then as Dan said, questions can be submitted during the presentation, and we'll have to be flexible about it, but we will be at a minimum directly responding during the panel or at the end. And we do plan to allow about 10 minutes at the end for additional questions. At this point, I'd like to introduce my fellow panelists, and I'll let them do it themselves. Why don't we start with Tom Fawkes?
Good afternoon, everybody. I'm Tom Fawkes. I'm a bankruptcy and restructuring attorney with the law firm of Tucker Ellis LLP in its Chicago office. Tucker Ellis is a 225 attorney law firm, full service, with offices throughout the Midwest and the West Coast. Briefly, in my practice, I represent debtors, creditors, unsecured creditors committees, Chapter 7 trustees, and post-confirmation trustees in a wide variety of bankruptcy and out-of-court restructuring matters. And it's a pleasure to be with you this afternoon.
Great, thanks. Tim Derry, why don't we go with you next?
Sure, thanks, Bruce. Thanks everyone for joining. Hopefully this is helpful for everyone today. My name is Tim Derry. I work in Pnc Business Credit, which is part of PNC Bank. The bank overall is the 6th largest bank in the country with around 450 billion of assets. My group specifically has about 50 billion of assets. And we focus on everything from ABL financing to software lending to Unitron lending. And we do that from direct to privately held companies, as well as quite a bit of private equity work. So my role specifically, I work on the originations arm of that of the bank with about a team of 7 or 8 originators, mostly focused on the Midwest, but we will lend nationwide with credit facilities ranging from as small as probably 10 million up to 500-600 million we'll underwrite and then syndicate off some of that exposure. So been with the bank about 8.5 years, been in Chicago for all of that. And again, happy to be here and thank you all for joining.
Great, great. And last but not least, Bill Fasel from Grant Thornton.
Hey, thank you, Bruce, and welcome everyone. Bill Fasel, I'm a managing director with Grant Thornton. As you probably know, Grant Thornton is a global professional service firm. I joined Grant Thornton about a year ago to really help various restructuring and turnaround efforts for the firm. I've got about a little over 20-year history in pure restructuring and turnaround and distressed M&A experience. I really focus more on, and our practice focuses more on company side roles, dealing with a myriad of financial and operational challenges, be it near-term liquidity pressures to helping companies through full-blown Chapter 11 and or restructuring initiatives. We try to deliver a more multifaceted kind of approach to restructuring, where we deliver kind of a integrated advisory, transaction support, valuation, some distress tax and performance improvement, but obviously situations call for different solutions to be provided at different times.
Great. Well, thank you for that. Why don't we turn into the webinar now, and let's set the stage. So we're now somewhere around 24 weeks or so into the pandemic, or as one of my partners likes to say, in the bunker. Back in July, Goldman Sachs had released the results of a survey of about 1,500 Goldman's small business customers. 90% of them had received PPP funds, and they found that 84% of those recipients thought that they would plan to exhaust their funding by the first week of August, and only 16% of the time said they're very confident they'd be able to maintain their payroll if no further government relief was provided. Well, we haven't seen anything from Congress yet, so I imagine those companies are bobbing and weaving to maintain their operations. So today we're going to talk about the companies that have managed to survive during the economic disruption, but as it was in an article I recently wrote, it's those companies that have sufficient liquidity during this period and are now either forecast to run out or have run out of working capital that need to, or now or in the very near future, to take decisive and deliberate actions. So having said all that, the general outline today for the webinar is we'll talk about operational perspectives, financing options, and then I'll end up with concluding with a Q&A. So let's start with the operational strategies with Bill. So Bill, what are you seeing and advising your clients to do when implementing the cost reduction and other initiatives?
Yeah, thank you, Bruce. And you're right. I mean, at different stages now we're at, let's call it I don't know if we're at the middle or if we're still at the front end, depending upon how we all view COVID and how it's progressing. But early on, we, as Bruce pointed out, everyone kind of went immediately into a much more cost control, cost optimization, cost reduction kind of process. And I think if you were having conversations with your lenders like Tim and others, you were doing your best to control what you could control from the inside. I think that that most companies have operated pretty well in that environment. But as Bruce pointed out, PPP money and other forms of government support have enabled companies to more or less survive. I think as you now enter into this next phase of whether or not there is government funding, how lenders may be reacting to ongoing issues, and whether or not they're going to be more proactive or aggressive in dealing with borrowers, I think one has to come back to some simple basics, which are reviewing your fixed and your variable costs, really trying to understand the supply and demand issues and that impact on your business, but recognizing that as you get into controlling costs and whether those costs be variable or not, you really need to assess whether it's compromising revenue generating capabilities or diminishing values down the road. So specifically minimizing risk, variable costs such as much as possible. For example, production, distribution, logistics can be outsourced, reducing fixed supply chain and manufacturing costs. Companies have done it. They're going to need to do it more. Then looking at your controllable costs, what can be deferred or eliminated, assessing and eliminating non-essential spending, including management and personal perks. A lot of this activity did take place, but now it needs to be scrutinized a bit more as you begin to assess your various contracts, your various issues that you're seeing out there with your business. And I think, as it relates to that, I think there's force majeure clauses and how you would get out of various contracts. And I know, Tom, I think you had a little bit you'd like to add to that.
Yeah, thank you, Bill. I would say that this would probably be one of the avenues of last resort. Obviously, when you're looking to reduce or eliminate costs that are arising under a contract, I think the best approach is always to approach the counterparty and see if something can be worked out. Obviously, during the pandemic, that has been happening frequently, and I think that in many instances, counterparties are being cooperative and understanding of the situation and are willing to work with the counterparties. Certainly you're seeing that in the landlord-tenant context, where tenants are approaching landlords for rent relief or deferrals of rent obligations, and landlords are, I don't want to say endlessly understanding, but at least somewhat understanding, and have been willing to work with their tenants on things like that. But there may come a time where you have a counterparty that is not so cooperative. And in that instance, I encourage all of you to be looking at your contracts for what are called force majeure clauses. Many contracts have them. What a force majeure clause is a contractual provision that excuses or suspends the performance of obligations when circumstances outside the control of the parties occurs. Well, a pandemic is one of those classic cases of something that is outside of the control of most parties. I guess maybe you could argue that the Chinese had control over it, but I'm not going there. But if your force majeure clause is broad enough to capture something like a pandemic or an endemic, and you may be able to use it to excuse yourself from a contractual obligation, I would certainly encourage you to consider doing that. I think it's important to keep in mind that force majeure clauses are very narrowly construed by courts. So if your force majeure clause does not expressly cover something like this, it very likely will not be able to be used. I think you're going to see a tremendous amount of litigation over the next couple of years as to the breadth of various force majeure clauses and the applicability of those clauses. And I'm certainly interested to see how that all shakes out. I think what you're also going to see going forward is that if pandemics are not written into force majeure clauses, they're going to be in the future. In fact, I would say it borders on malpractice if an attorney does not write in pandemic coverage into a force majeure clause for a contract from this day going forward.
Interesting. Okay. Bill, back to you.
Yeah, thank you, Tom. I mean, and I think also, as one looks to look at their cost structure, you're looking also at your SG&A and your headcount. You're looking to rationalize it. You're looking to institute policies that encourage and reward cost savings and conservation. I think another issue, Tom, might be relating to how companies have instituted those cuts, how those have played through the PPP kind of programs, and whether or not you'll continue to see that kind of rationalization and or limitations on rationalization as we move forward. Again, maybe commenting from a legal perspective.
Certainly. I think there are two things that you need to be taking into account, among other things, when you're considering reductions in headcount, and that is first the PPP program that Bill mentioned, and second, the WARN Act that applies both on a federal basis and in many states. I'm going to be talking more about the PPP program later on in this webinar, but let's talk about a couple of things right now. For those of you who were fortunate enough to obtain a PPP loan, you're undoubtedly aware that the entire point of the program was to incentivize employers to maintain headcounts, to maintain salaries at levels consistent with where they were at the beginning of the pandemic or before the pandemic came about. So your ability to get your PPP loan forgiven is in part tied to your maintenance of salary levels at least 75% of where they were prior to the pandemic. If you fail to maintain salaries at that level, there are some exceptions, which are probably a little bit outside of the scope of this webinar. But if you are unable to maintain those levels, that is going to impact your forgiveness, and you will not be able to get the entire loan forgiven. We'll be talking a little bit later about how we are hopeful that there will be a continuation or an extension of the PPP program. So those of you who have not obtained a PPP loan that are looking to get one in the future, you'll have to keep these things in mind for when you do. The other thing is the WARN Act, which again is a federal statute that requires employers with at least 100 employees to provide 60 calendar days notice in writing of a plant closing or a mass layoff. You have to keep in mind that in certain circumstances, a temporary layoff or a furlough can actually trigger a WARN Act obligation. And that's especially the case when those furloughs or layoffs become long-term or permanent. There are exceptions to WARN Act obligations, and probably the most applicable exception in our current times is called the unforeseeable business circumstances exception of the WARN Act. And that might include an unanticipated major economic downturn. Well, here we are. I don't think anybody anticipated the current downturn that we're experiencing, not to mention governmental ordered closings of businesses, which we were definitely facing in spades in March and April, and are even facing to this day. So there may be an ability for an employer to still engage in a mass layoff, and notwithstanding its inability to comply with the WARN Act and provide that 60 days notice. But again, these are very fact-specific exceptions. I can't tell you sitting here now if you would be able to take advantage of them. One thing I want to note also is very serious consequences to a failure to provide the required notifications under the WARN Act. It triggers an obligation to provide back pay and benefits to affected employees for at least a 60-day period, and can also result in civil penalties. So important to keep apprised of those obligations.
Okay. Let me bring it back to Bill. Let's go back to the customers and suppliers area, because I think that I don't want to beat on the WARN Act too much. Bill, how do you talk about evaluating customers and suppliers?
Well, that's, Bruce, great point. I mean, you yourself, companies are analyzing their own financial viability. Well, you got to assess both the financial viability of your customers and suppliers as well. So in doing so, you really need to understand kind of your existing credit terms with your current customers, trying to negotiate the shortest possible credit terms and really then reviewing that credit worthiness of each customer before you're taking on credit. I mean, it sounds, like a standard operating procedure, but it becomes so much more important today. And so I think we're going to, have a real need to focus again on customer viability. As it relates to suppliers, I mean, you definitely look to monitor and negotiate for the best kind of favorable terms that you can get. Evaluating your supplier base, making sure you've got the best current agreement in place, and talking, communicating. You're going to hear communication as we get to lenders and financial side of this, but communicate with both parties as well as much as you can, and get a sense of room both on both sides in terms of providing you for the added liquidity. I think you also now need to turn your attention to also, as you look forward now, where is the strategic growth and where are the investment plans as we continue to operate in this uncertain world? Every consumer behavior has been altered by this crisis, especially any people-to-people business. So if you're in an operationally intensive sector, COVID and the pandemic has accelerated, automation, digitization. It's the need to upskill and reskill your workforce becomes a priority. If you're in the consumer goods sectors, reshaping that sales function, collaborating between your retailers and manufacturers is critical. Your supply chains all have experienced intense disruption. So how you begin to be judicious moving forward to both your capital and your time to how you view the post-pandemic world is going to be critical. And key themes like how will the core markets and segments be impacted moving forward? How dramatic and long-lasting will these changes be? I think people underestimated sort of the time frame for a return to normal. How do you capitalize on markets and segments that are going to benefit? How do you de-emphasize those that you don't think will? How do you have enough time to accelerate growth organically, or do you need to consider acquisitions? Basically, how are you aligning your opportunities with your core capabilities and recognizing that you need to stay and remain competitive moving forward is the beginning of that strategic growth emerging from a pandemic environment.
Hey, Bill, let's go toward your clients' financial strategies. What have you seen them doing, not to keep you on the hot seat for the whole thing, but what have you seen them doing and what have you been advocating with them?
Yeah, I think on the financial side, facts, circumstances are vital. You really, depending on industries, depending on certain segments of the market, being as nimble and as focused on your business plans and your forecast is essential. The old adage, cash is king, you've heard it from the time that COVID started. You're going to hear it at any point in time through this emergence. Immediately assessing and understanding your weekly, daily cash needs becomes more critical to the extent that you are really trying to understand your runway, your near-term runway, your midterm and long-term runways. Implementing a cash flow forecasting process that includes detailed and thoughtful scenario testing and variance analysis is critical. Recognizing that potential disruptions may have, impact this near-term or short-term liquidity, and recognizing kind of how you're managing your working capital becomes essential. Also, the issue of working capital is an interesting one. I mean, we get pulled into situations where companies are either out of working capital immediately, or situations where it's 2 to 4 weeks down the road, it looks negative. Recognizing kind of that runway and being able to implement kind of changes and or understanding how to safeguard against limited liquidity is essential. So, I think one thing, Tim, on the lender side is, how the deferral of P&I is playing into it, and how companies are working with their lenders constructively to really look for amendments, extensions, modifications. I think that's a essential part of your game plan moving forward. And then obviously, again, looking internal at your inventory management, key drivers of working capital, and assessing kind of what do you have to identify sort of quick wins. How quickly can you accelerate your inventory turns, and then moving over to your capital expenditure plans, really trying to consider whether or not certain plans can be delayed until the external environment becomes more stable, but really trying to manage your business with a longer term view towards emergence, and not jeopardizing your ability to emerge.
And one of the things that we've run into is it's always hard, unfortunately, to balance that inventory. How lean can you get your inventory while at the same time, just because of all these supply chain issues that have occurred because of just being able to get product, whether it's from Asia or even Mexico. And also we've had a number of supplier disruptions where they couldn't get all their personnel back to actually manufacture. So you have this ebb and flow of just the variability of your inventory that can affect your own production to be able to meet your own customers' needs.
One other issue, Bruce, that we've been experiencing is that as difficult as it has been to manage within and prepare for this pandemic and operate during, is emerging out of it and recognizing the liquidity drain that can happen when you bring that workforce back, and how quickly do you bring it back, and what human capital strategies do you have to ensure that that while the demand seems to be coming back, how quickly are you ramping back up and managing that? And again, it's almost as significant a challenge as going into COVID.
Yeah, it's unfortunate, but that's true. We've had a number of clients where, what we call, it's not necessarily hazardous duty pay. I'd almost call it, hostage pay, where the employees didn't want to come back because they were getting the extra money on unemployment, and you had to match that amount to get them back. But yeah, there's obviously a lot of interplay of a number of items. Why don't we turn it over to let's go to our banker on the panel. Tim, what are you seeing with your customers, and what kind of requests, et cetera, are going out there where you're being able to provide some level of liquidity?
Yeah, generally, Bruce, I'd say that for our region here in the Upper Midwest, we have about 120 borrowers. Now that's just in Pnc Business Credit, not the whole bank, obviously. But generally speaking, I'd say it's kind of the 60-20-20 rule. We had 60% of borrowers that maybe hit a little bit of a bump, but generally, we're able to stay open and get through it without major requests. We had 20% that thankfully benefited and were part of the few that did well and have expanded their businesses. And then we had 20% that really got hit hard, whether they were in kind of the restaurant supply chain or other sort of service businesses. So because of that dispersion of performance, I'd say the requests have been all over the map. There's absolutely people that in the first month had pretty dire liquidity needs and came to us asking what we could do to support it. And then to Bill and your point, Bruce, there's been people that in the 20% that were positive, they were actually looking for capital to support their customer base because they were doing better. So it's been everything from more capital to covenant waivers, covenant resets, everything really up and down the chain. Interesting.
Have you, when you had the customers coming in and asking for the P&I deferrals, if you had to guess a percentage, how many of those did you actually grant? And I don't mean it, I got to be careful about it. I know you're not allowed to make representations necessarily for PNC, so I'll defer to how do you want to respond to that. But what are you seeing in terms of requests?
Yeah, I mean, I'd say, and this will get into some of my notes, but just generally speaking for the guests that are listening in, I mean, banks in general, because I've worked at a few, and whether it's a bank or a lender, most of us like to stay current on interest, just given some of the regulatory ramifications if the borrower, quote, can't pay their interest. So the simpler request is to reduce or try to defer amortization. There's a lot of things you can do there. You could just simply say, instead of making a payment on June 30th, you're going to make it September 30th. That would be a pure deferral. You can also reduce that. If it was supposed to be 100 grand, make it 25. So PNC's approach, or my team's approach, is really to take it and look, situation by situation, and with as much information as we possibly can. I think some of the folks that came in with requests made the mistake of saying, "Oh my gosh, we don't know what's going to happen. We need to reset our amortization and our covenants for the next 3 years of our credit facility." That to us feels too long. We don't need to all make a decision for a 3-year time period with what we're dealing with today. Let's try to break it down into 3, 6, 9 months, and if we have to revisit it, then make the next decision based off the best information we can at that time.
For those of you that aren't out there, that aren't familiar with what we'll call the private credit firms or the non-bank lenders, obviously in working with Tim and PNC and the other money center banks, you've got much more, let's just say, functional parameters you have to work with, especially on the ABL side. Have you seen any of these non-bank lenders come in aggressively to offer even higher advance rates or more flexible terms or availability to potential borrowers?
Yeah, it's one of the very good things of today's kind of lending market in dealing with this pandemic is if you went back, when I started lending 15 years ago, I guess, but if you went even further back than that, it was all really banks and then some the proliferation of new firms is it's numerous, whether it's a FinCo ABL firm or what we call the direct debt private credit funds. The options borrowers have are so numerous that it really does provide a lot of avenues to get out of a difficult situation with a specific lender and move yourself into a different avenue. So, to get to your question, I guess, we absolutely have seen finance companies that do asset-based lending creep down and replace banks. Typically if you go back 18 months ago, they were really having to deal with kind of the very difficult problem credits. Nowadays, as banks have tightened up, they can come down into, call it a C+ B- credit and get the yield that they require in structures that really aren't advancing all that much more than banks would have been doing 6, 7 months ago.
Yeah, we've had some clients where we'll go the other way, where the bank has come to us and said, these guys actually do need help. They've got more collateral availability than we're able to give them. Can you help us refinance them out? Mm-hmm. So anyway, so what are are there any other expectations of borrowers that you've had so far that they aren't that we haven't addressed yet in the dialogue here?
I think and I'll answer this twofold, but it's almost the same answer. First, going back to April, May, when there was problems, and this will be relevant for anyone that experiences them in the future. But I'd say the most difficult conversations, or the advice I'd give someone not to do, is to call your lender and make effectively an uninformed ask. To Bill's point in terms of planning, liquidity, 13-week cash flow forecast, going into your lender and saying, "Hey, this is what we need, and we need you to solve it." I think a lot of us on the panel, and hopefully folks listening, would laugh, but it's surprising at how many of those requests we got that people just kind of said, "Hey, this is the bank's problem." Like, we absolutely view ourselves as a relationship lender, but we want to be doing that in partnership with the ownership. So when people come, they say, "This has occurred. In this instance, the whole world is dealing with it. Here's how it's going to affect us. Here's our plan to mitigate some of those actions. And then here's a reasonable request of PNC or your lender that we would like you to evaluate. And oh, by the way, here's what we're doing." I think that is going to set you off in terms of your negotiations and what you can get out of your lending partner as best as possible. Coming in and saying, "We can't help. Let us know how you're going to fix this," typically starts off on an unfortunate path. And that, I said, that's problematic, but Bill hit on it, And I think we all hope that it's actually become very relevant, as we climb out of this and revenues either just simply start to recover or hopefully even grow. A lot of these businesses have stretched their balance sheets. They've thinned down AR and inventory as much as they can very wisely to generate cash, and then they've stretched the AP. So when growth comes knocking, who is going to finance that? And then that's where it gets, you need to know your lender. If you're in a cash flow facility, you might have a dollar limit on your revolver, which, then once you cross that, you can't borrow more. If you have an ABL facility, it does come with more bells and whistles, but you might have more flexibility because they'll finance 85 cents of every dollar of AR or a certain percentage of inventory. So as growth comes, someone's going to have to finance that working capital, and what liquidity facility you have via your revolver can determine how much you can get from a lender or not.
Okay, thanks. I'm going to go back to the non-bank lenders because a question came in. Are the non-bank lenders lending with same terms as rates? Which I'm going to let Tim, I'll let you hit it. I don't know if you have as much exposure to it as Bill does, but why don't you address that first?
Yeah, so within our private equity practice, we do quite a bit of Unitron financing where it's all one credit agreement to the borrower, but PNC does the front end of the Unitron, and then a direct lender does the back. So we partner with a number of different firms. It's probably in the 40s or 50s these days with as many as there are. I'd say that as a group, they've come back to some degree early on. If it was 40 that we would call on a deal in April and May, there was 2 or 3 that were legitimately active because much like a private equity firm, they have a finite amount of capital from their fund. And as they didn't know due to lack of, information, how bad those situations were going to get, and if they would end up owning those companies or not, or if they needed to provide new capital to support existing portfolio companies, just the times made them kind of clamp down to wait and see what they had within their portfolio. But I do think it's alleviated to some degree in the last 6-7 weeks.
Yeah. Bill, what are you seeing with your customers or your clients?
Yeah, no, I think that's right. I think where Tim's coming at it, it depends, I guess, is the answer.
Yeah.
You really depends on that situation. It depends on that credit. It depends on that industry. It depends on that prospect. I wouldn't say that I'm seeing necessarily the same sort of lending rates across the board. I would say that they tend to be a little high, the risk reward ratio for certain of the industries or situations they're going into tend to potentially drive a higher rate and a higher demand. And so I from my perspective, it really does depend, and I do think it's going to challenge a fair amount of companies that were healthy going into COVID and now coming out, not really recognizing kind of where rates and rate structures may head for at least the near term, as they now have limited liquidity and less kind of financial cushion that they had once. So these will become challenges and are challenges.
Yeah, let me just hit that. So one of the things I've seen with our clients is we've really got this bifurcated financial market where on the one hand, you have those companies that are truly creditworthy, they're performing well, they're within formula, et cetera. And that's how the banks, the normal traditional commercial lenders, ABL, et cetera, like. And on the other hand, now you kick it up, 300, 400, 500 basis points when you start going into the non-bank lenders. Now it's not as high, the spread isn't as high as it used to be. It has come down, but in as much as their lines, they aren't banks unto themselves. They're also levered because they're getting financing from Wells Fargo, from Capital One Bank. I'm trying to think who else the other lenders are. But so as they've been constrained also, their capital does become more expensive, but they're still having to deal with what they're doing. So they can give higher advance rates if they have the availability themselves, but it's also going to cost you at least 300 to 400 basis points more than a traditional bank. Okay. Why don't we talk about other sources of liquidity? Tom, what would you advise for other sources when you're working with your clients? And by the way, I was going to say you're on mute, but
so there's a number of options that you ought to be considering if you need to raise liquidity. and you have kind of exhausted, we'll say, the debt sources that Tim and Bill have been talking about. Obviously, the PPP program and other government grant or tax credit programs have been very popular over the last several months. I want to talk a little bit about the PPP program because my guess is that we're going to see it reemerge if Congress can find a way to come together and pass another bill that extends the program. That has been something that has been in the works now for close to a month. There have been a lot of difficulties in the Democrats and Republicans finding common ground, but I think eventually they will do that. So the PPP program obviously was originally authorized by the Coronavirus Aid, Relief, and Economic Security Act, called the CARES Act. And over 2 rounds or 2 phases of the PPP program, about $650 billion was earmarked by Congress for these loans. Incredibly, even though the phase 2 of the program expired on August 8th, there's still $130 billion left that was not actually borrowed. So I'm hoping that $130 billion and maybe even more so, then additional funds will be made available in the phase 3 funding. So briefly, what does the PPP program provide for? It provides for a loan that is potentially forgivable that must be used primarily for payroll and then for other certain specified expenses. Under the original tenets of the program, 75% of the loan proceeds had to be used for payroll. That was then reduced to 60%. So the current program requirements are that 60% of the program be used for payroll, and that is for employees that make under $100,000 a year, which is inclusive of benefits. The original round of program funding provided for 8 weeks, an 8-week usage period. It was then expanded to 24 weeks. My guess is that in any phase 3 PPP funding, you'll have that 24-week period or perhaps even a longer period to use the funds. So long as you use the funds in accordance with the requirements of the program, there's a high degree of likelihood that that loan will be completely forgiven upon review by the bank that provided the loan and by the SBA, which is obviously guaranteeing repayment of the loan. That process takes a lot of time though. The current SBA guidance is that it'll take approximately 150 days after submission of a forgiveness application for the final decision to be made by the SBA. And if your loan is for more than $2 million, you should probably expect it's going to take even more time than that because loans over $2 million are subject to an automatic SBA audit. So any of you out there that have obtained PPP loans, I hope that you have already submitted your forgiveness application. They started taking applications, I believe, 2 weeks ago. But you want to make sure you do it quickly because you're going to want that decision in fairly short order on the forgiveness decision. Here's the good news. Even if there is a likelihood of non-forgiveness of the loan, it is still a worthwhile endeavor to seek the PPP loan because the repayment terms are very, very attractive. It's a completely unsecured loan that bears 1% interest. Tim, I'm sure he would try his darndest, but he probably can't provide you a loan with that attractive of terms. So I would certainly encourage all of you that meet the requirements of the program. It is for businesses that are either under 500 employees or meet certain definitions of small businesses under SBA regulations. If you have the ability to obtain one of those loans and the program reopens, I would certainly encourage you to look to that first as a source of liquidity. Let's say you don't have that at your disposal. Sorry, Bruce.
No, I was just saying, what's the amortization period if it's a non-forgiven?
So yes, under phase 1 of the program, it was a 2-year amortization. Under phase 2, it's a 5-year amortization with at least the first 6 months of interest and principal deferred. Moreover, there is an expectation that you are not required to start repaying the loan until the forgiveness decision has been made. While interest will accrue over that period, you won't have to start making payments until the SBA tells you the loan's not forgiven. So that means that you probably are going to have anywhere from 6 to 8, maybe even 10 months before you're going to actually have to start making payments if the loan's not forgiven.
Just as an aside, tactically, we actually have had a client who made the decision that they were going to take the money They weren't bringing all the employees back, and they knew it was a conscious decision that it was going to be a 5-year note at the 1% interest rate.
Yeah, I mean, I think from a tactical perspective, that makes a tremendous amount of sense. And I don't want to get into whether there could be, in certain circumstances, if you are viewed by the SBA as having abused the program, there could be consequences to that. But we're so early in this pandemic and in this process that I don't even know what would constitute an abuse of the program.
Yeah.
But I agree, Bruce, that you take the money, you do not fall within the requirements. Yes, you're obligated to repay the loan, and if you repay the loan, that should be enough.
What about? I'm sorry. Go ahead.
Go ahead, Bruce.
I was going to say, what about the Main Street lending program? Have you gotten into any of that with your clients?
I personally have not gotten into that, other than just generally being aware of what it is. But no, I have not worked with any of my clients on that program. I'm not sure if Tim or Bill have any thoughts or insights on it.
Tim?
We have looked at it. I'd say generally the program, and this is not PNC specific, it's for all banks. There were some aspects of how it was written with the debt that comes on needing to be pari passu pro rata, that just made it more difficult than the PPP. Obviously, the PPP, Tom hit on it. It's unsecured money behind the banks. It's a little bit more of a threading the needle exercise in my mind to get a Main Street loan through the process.
We actually have a client that got about has been approved for $10.5 million under the Main Street program, but I understand it wasn't without an insubstantial effort.
Yep.
So why don't we shift around about some other, let's just say, non-traditional ways or just access or areas of funding. What about anybody have any experience with selling the unutilized excess non-core assets?
Yeah, Bruce, I can address that
Okay.
for a moment. So certainly everybody ought to be looking at assets that you're either not using or not using profitably, and considering whether you have an opportunity to unload those assets to raise some short-term liquidity. I think an important thing to keep in mind is that you'll want to look at your credit agreements to determine whether you number one, need consent from your lender in order to engage in those sales, and number two, where the proceeds go. If the lender's allowed to take all the proceeds of the sale, it may not be an appealing option to you from a liquidity perspective. There's a situation where I would suggest going to talk to your lender before you engage in that sale process, perhaps getting some special dispensation to either be able to keep the proceeds or to even split the proceeds with the lender, at which point you could engage in that process. I think another option there would be looking at your equipment leases or financed equipment and considering whether it may be advisable to seek to abandon or surrender that equipment to the lessor or to the lender. Obviously, again, that is going to require lender/lessor consent. It may be a situation where if the lender/lessor believes they can take that equipment and flip it, they may be inclined to take it off your hands, and that obviously is going to alleviate a potentially significant obligation for you in the future. Though you need to also keep in mind that if you engage in that, in addition to having lender consent or lessor consent, you're probably going to be faced with a deficiency claim or perhaps an early termination penalty in the case of a lease that you're going to have to consider and determine whether you can absorb that obligation.
We've also run into the other side of that where, for example, you have, let's just say, unencumbered assets that are not, and even if it's machinery and equipment, they're not subject to liens from the senior lenders, where some of the companies have gone out and done sale leasebacks on their operating equipment. We had a situation recently where our client had, they had a couple of large loans outstanding, but the majority of it was secured by both real estate and machinery equipment, but they had about $5 million of excess collateral. We were able to successfully discuss with their lenders to free up that excess collateral and go out and get additional financing against that. So you should look long and hard, in my opinion, against everything you have that's not bolted down, and even some of the things that are bolted down, to see if there's a good rationalization, and do you need it? Will you be using it in the near future? Are you getting rid of strategic capabilities? But on the other hand, is it something that, and again, I'm not advocating taking on even more debt. Obviously, prudent debt levels are important, but if it's something where you have a current cash need right now, these are options.
And Bruce, I would add to that, and it kind of goes hand in hand with what Tom said. Knowing your credit agreement is of utmost important there, because whether it's doing a sale leaseback, which is additional indebtedness, but where are those proceeds going, or to Tom's point, you're going to sell equipment that you're not using. In most bank deals, if there is a term loan involved alongside a revolver, especially the fixed asset sale is likely to pay down your term loan. And when you pay down your term loan, that doesn't increase liquidity. But to what I said earlier, if you go early on and you lay out your plan, we're not using this equipment. There's no banker in the world that should tell you you should or shouldn't sell your own equipment. Companies are better than we do. They just want to know where the money's going. So if part of the plan is saying, look, I know it's supposed to go to the term loan. We all know we need liquidity. Can we get some reprieve off that and do some sort of mix or whatnot? You're just always going to look better prepared and get a better answer by involving them early on.
Yeah, and one of the things we've had a great degree of success with is when the customer, when the borrower goes to the bank and says, "Look, here's what I need. Here's what I'm prepared to do. Can you do this in partnership?" Yeah, and one of the things I also want to talk about, it's really going down that path, is the concept of getting additional equity. And Bill, I'm going to flip this over to you. I don't know if you've had that situation recently with any of your clients.
Well, obviously equity comes at a higher cost, right? And you're looking at a different sort of now constituent entering your capital structure, and and you need to recognize kind of their motives for that insertion of capital, and whether that's a obviously minority position or a majority position. We've looked at situations where the need to refinance and or recapitalize was critical, with and the alternative really wasn't going to be provided by an alternative lender and or a commercial lender, and forms of mezzanine lending have come in, forms of private equity capital have come in. I think at the end of the day, a number of our situations that get forced, in essence, to find alternative capital and can't source it in a traditional sense from a lender, tend to go down that route of a quasi sale process, where we clearly are looking at different kind of capital sources as a way to recap the company. But again, like I said at the onset, it really comes down with the motives, the real stress that you're currently feeling, and the pressure you're getting from your various capital contributors. So, I mean, it's something to consider. It's definitely something that, as a strategic alternative, you want to assess. But at the end of the day, you guys got to make sure it's most optimal.
Let's also throw in the monkey wrench right now, which, the other side of my firm is Healthy Company Investment Banking. Oh, by the way, how are you doing your management presentations? How are you doing your tours? How are you getting the on-site due diligence, which is not easy in this current environment?
Challenging, yeah.
Yeah. Tom, you were going to mention, I'm sorry, go ahead, Bill.
No, I was going to just, especially if you have limited visibility on demand, right?
Yeah.
Continued limited visibility. So,
Tom, what were you going to say?
Yeah, so one other thing I think all of you ought to be taking into account as a way to generate additional liquidity, though albeit not in the short term, is to keep in mind that under the CARES Act, there were some modifications made to how certain corporate entities can carry back net operating losses. So under the 2017 Tax Cuts and Jobs Act, NOL carrybacks were limited to 2 years. That has been expanded under the CARES Act to 5 years from tax years 2018, 2019, and 2020. So you may want to engage in that analysis when you're preparing your tax returns for next year, as it may entitle you to a tax refund that you otherwise wouldn't have been able to generate under the pre-existing tax laws. I say this with the caveat that I am not a tax lawyer, but I guess I know enough to be dangerous.
There you go. Okay, and you don't play one on TV.
I do not.
Okay. At this point, we're starting to run up on time. We're about 10 minutes before the hour, so I want to start bringing this back together. Obviously, as we go through this, the whole COVID pandemic has been causing unprecedented challenges, but it's also creating opportunities for companies to consider their bigger picture. We've seen a number of companies that have kind of changed their business plans and gone into alternative products, other industries. They've had to think a little more holistically and say, what in fact do we do? What are our core competencies, and how can we adjust? But if you go back to one of the fundamentals of what buyout firms used to say a long time ago, putting debt on a company makes them think more creatively, and sometimes they operate better with less working capital. Not advocating for that. I'm just saying that's an option. Another thing is, you should be asking yourself, is your company ready? Is there something you can do in this environment to position the organization to be a stronger, better company on the other side of the crisis? Is this an opportunity to restructure and improve the business model? We've actually seen a couple of clients where they have consciously gone through their customer list, looked at customer profitability and amounts of capital that are required against those customers, and they've fired customers. As inexplicable as that may seem, but they make themselves better, more profitable, and require less capital to do so. So I guess at this point, the one thing I would say is, where there are problems, there are opportunities. I don't see any questions right now on the live Q&A screen. I don't know if anybody has anything that they'd like to type in. One of the things that I'll just turn around, and Tim addressed this a little bit earlier, but while we're waiting to see, I'll just hit this to Tim. So once the economy gets back up and running someday, what kind of stress is that going to put on the banking industry? What do you see coming down the road?
I think it's a little bit to what I hit on earlier. I don't personally feel that the banking system is incredibly stressed right now, but what happens until we get to your point, Bruce, where now we're truly coming out of it. If it is very stressed at that point, my concern is simply who funds that growth. Because if the bank's balance sheets are stretched, and then the borrower's balance sheets are stretched, and growth comes knocking, someone is going to have to front that, and it's going to have to be part banks, but then our borrowers, but then our borrowers' customers, our borrowers' suppliers. It's going to have to be a very well communicated thought process of how the money flows from raw material through the household good sitting in all of our homes right now, and how it gets paid for along the way. So I just hope there's enough liquidity still in the system that the banks can take on more of that capital, considering it should be I guess that we can take it on and we can underwrite the risk with good information. Because if you have both of those, I think we should be able to support a number of borrowers.
Great, thank you. Well, I don't see any questions, so I think we'll take this opportunity to start wrapping up. Personally, I'd like to thank Dan and Susan Gidley, the FEI administrator, for allowing us all the opportunity to present this webinar to you. I'd also like to thank my fellow panelists for making the time available. With this point, I'll turn it back over to Dan, and I think most people that are on can probably resume their day drinking activities that they've been doing in front of the computer screen for the last 25 weeks.
Well, thanks very much. And on behalf of FEI, I'd like to thank all of our panelists for a great and engaging presentation today.